Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets.
Well, it was an interesting week. The Dow hits 40,000, and certainly we see a lot of attention paid to the U.S. stock market. But Jeff, what I wanted to do was ask you some questions about stock markets from around the world, specifically in Asia and what's going on there. And it's interesting that oftentimes when we talk to investors or advisors, a lot of people think that markets move in tandem with respect to different regions of the world. Is that true? Are we seeing that in Asia?
Well, that's been the rub for a few decades. It used to be that you could go in and engage something like a tracker of MSCI developed or emerging, and you could get a very low correlation to the S&P 500. And that basically got whittled away as the years went on, as computerization took hold. They could do everything on a click of a button. But we do see some evidence of anti-correlation going on inside some of these Asian bourses over the last maybe a year or so. You don't know how long it's going to persist. But it's promising because some of the major economies are zigging while some of the others are zagging in the stock market. And it's just something that you don't frequently see. It's kind of a manna from heaven from an asset allocation perspective.
Well, a lot of attention when you talk about Asian stock markets used to be Japan, and it seemed like China came more into vogue. We'll talk about Japan in a second, but just what's going on in China? Is there anything there economically that investors should be aware of when they're thinking about investing?
Well, I mean, it's kind of a tale of two situations, or a tale of two stories, really. If you think about the action in Chinese equities in the second half or so of last year, Hang Seng Index, which is the Hong Kong stocks, that peaked back in late July of last year, and it found a bottom in January. But the action, Kevin, in that time, it lost about a quarter of its value just in that window. And that was after, remember, it had just been tanking in 2021, 2022, and 2023, but it lost about a quarter of its value in that 6-month window of time. And the reason was because we were all entering 2024 bracing for essentially a 4 handle on mainland China on the GDP number there. And now I think that there's been something of a relief, certainly with this relief rally, which has propelled Chinese stocks inexorably higher on account of, okay, maybe it's not 4 on real GDP. Maybe it's something in the mid 5s. It looks like Q2 GDP is going to be in mid 5s. Last week, we had the industrial production number came in. I think it was like a 6.7 was industrial production on year over year for China itself. That's a relief. That's the type of thing that's a sigh of relief for the market. And you have Chinese stocks just ripping higher at this point.
Yeah, well, there was more recent news, right? I believe the PBOC and or Chinese government just recently announced some hopeful measures on the stimulus side as well, right?
Oh yeah, to support the property, the property slow deflation of that bubble, which is now called 13 quarters old. If you go back to the first quarter of 2021, and it's interesting because you do have this action in Chinese equities, and it's kind of zigging while the other neighbors zag. I mean, when China was in the total tank last year, Indian stocks, Japanese stocks basically said, "What's China? We never heard of China. What is that? We don't care. Going to rip these stock markets so much higher." Now you have China. I mean, it's been bold. I mean, the Hang Seng's gone from essentially 16,000 to nearly 20,000 in about a month, and Japanese and Indian stocks kind of chopping sideways, digesting last year's gains. It's an interesting situation because the S&P wants to rally with Chinese stocks. The S&P carved out its nearby low on April 19th. It was in the 4,900s. Now it's around 5,300. So we have correlation going on with the S&P in China. So that's no good for an asset allocation perspective. You're supposed to get this diversification. But if you look, India and Japan are kind of marching to the beat of their own drummer. So if you wanted to outsize some of these markets, you could at least know, hey, if my China is on, maybe it's being offset by my Japan being off. But if my Japan is on, that's cool because my my China could be off. So there's this anti-correlation going on. It's absolutely fascinating to watch it unfold.
So, I mean, that brings me to my final question then. I mean, you're talking about, say, this lack of correlation. What if investors, say, don't want to get involved in the Chinese market? Would you suggest Japan or India as an alternative place to go?
Well, those are a couple of our big longs, and you could do an emerging fund ex China. I mean, a lot of us are playing in that basket. But certainly, I mean, if you have the vagaries of the Chinese economy not seeming to influence these other economies, then that really propels a whole new type of bull case, because it used to be, oh man, if the Chinese economy is rolling over, well, I don't want to have anything to do with something like Japanese equities. Why would I want that? But it seems to be that we're gaining some level of independence in some of these other stock markets. I think people are looking at some individual countries. Asset allocators are thinking more about country rotation. So yeah, those are definitely ideas, because they seem to be, I mean, just look at the tape in the last year. They seem to be almost, if not, like, I'm kind of joking about it, but almost like China who? China what? We don't really care. We're marching to the beat of our own drummer.
Well, thanks, Jeff. I think we're going to end it there. We just wanted to provide you all with some insights. As always, the focus here is always concentrated on the U.S. I think it's great to have a conversation about what's going on outside of the U.S. equity markets. So thanks a lot, Jeff, and everybody be well.